All right, well, good evening, ladies and gentlemen, and welcome to our special presentation on how to invest in mortgage notes, where I'm going to cover with you guys how you can learn to become the bank in real estate. Okay. Now, my goal here for all of you is to understand the material and the concept of this well enough that you can communicate it with other people, because you need to look at this presentation not as a how do I fund notes as a wealthy person, or how do I get into the note space when I've got a bunch of money. I want you thinking about this business about how can I make money even if I don't have any money. And for that, we're going to cover something tonight called subservicing. Okay, so I want you to write that term down, subservicing, and I'll explain it real quick because it's a pretty exciting concept. If I go out and find somebody that's got a performing note that, let's say, is paying 12%, and I know that an investor friend of mine is looking for an investment where they want to earn an 8% yield, I can actually partner with them to buy that 12% note. They would get 8, I would get 4. Okay. Now this is what's called subservicing. Now this is not an advanced topic, although I'm introducing it right here at the top, because I want everybody to understand my purpose in being here with you today is to teach you how to do this stuff, because as a company, we are continually originating mortgage notes, and then we are selling those mortgage notes. Many of you know that we also have a new program called Sub 2 funding, where we're now providing second mortgage liens behind existing firsts, where the combined LTV does not exceed 70% of the value of that asset. So now there's a second mortgage component piece that's really exciting. We are also now, through our brokering program, we are teaching you guys how to go out and find existing mortgages and bring them to our company so that we can buy those mortgages and pay you a fee for bringing them to us, or said differently, you are wholesaling mortgages to us that we can buy. And there's another opportunity where you guys can bring us a note that you would like to buy, and we can provide you up to 75% of the money that you need to acquire the note. So you go out and you find a $100,000 note that you've negotiated down to a $50,000 purchase price, and you don't have 50 grand. Well, guess what? We'll bring in we would bring in 75% of 50, so that's going to be roughly 82.5 or 40. Well, we'll do the math. It's roughly 44,000, and you would bring in $6,000. No, it's 12. Okay, you would bring in 12. We would bring in 38, and together we would be at 50,000. So that's another new loan product that we have available for all of you guys to utilize and participate in. So a lot of fun stuff, a lot of new products, a lot of new and exciting things happening here at Secured Investment Corp. So the way that tonight has been built, all right? Obviously, I started with the introduction and gave you all the really exciting, sexy things, right? Now I'm going to go into the kind of the nuts and the bolts and the meat and the potato of the note business. Some of the terms you need to know, some of the math, some of the structure of these things. And then at the end, I'm going to pull it all together so that you guys will know now, okay, how do I take all of this incredible information and now go out and start generating profit with it, okay? Now, we will end with some Q&A. I'm not going to stop. We are live. I'm not going to stop in the middle of the presentation to address the questions as they come in, so please don't get frustrated if you're not getting answers right away. But I have 2 producers in studio with me. They're monitoring your chat. They're monitoring your everything. And as you guys put those questions in, time permitting, we'll do a little Q&A session at the end and hopefully get all of your questions answered. My goal at the end of this is for you guys to be knowledgeable about the note business, understand the extreme level of profitability that exists in this business. Know the fact you should be so excited about it is that there are very few people, even seasoned real estate investors, that don't have a clue what we're going to be covering here tonight. And then finally, how you can take this information and go out and literally start generating income in the next 7 to 14 to 21 days. It doesn't take a long time to get profitability from this business, but you do need to understand the basic tenets and components of how it comes together. Everybody good? We are live, and if you guys could turn your cameras on, I will tell you, you're going to get a much better presentation out of me if I can see your beautiful smiling faces, because I love seeing your beautiful smiling faces. Because without you, I'm stuck in this cramped little studio with two dudes, you know? So you guys are my outlet to the world, and I love it. Okay. All right. There's Charlie. I see you, Teresa. Kahindi, I see you. Sydney, I got you. Ann, Roz, I see you. Samuel, there you are. Marilyn, welcome. I see Johnny Hogan up there. Let's see who else we got. We've got, I see Samuel. All right. Keep those cameras coming on, you guys. There's Ronaldo. There's Alfonso. Thank you. I need more cameras on. I'll turn this thing off right now. Clara Peterson, I see you. Welcome, Clara. And there's Donna Tuttle. Welcome, Darla. And welcome, Donna. I see Charlie Palmer multiple times. Are there two Charlie Palmers here?
No, it's a registration link.
Okay. Okay, so now everybody's just coming in as Charlie Palmer.
There's like 8 of them in there.
All right, that's cool. All right, let's jump into it, you guys. Quick disclaimer, this just makes my attorneys happy. Past performance is not an indicator of any future results. All investments contain risk and may lose value. Any historical returns, target returns, expected returns, or probability projections, you can read the rest. Neither Secured Investment Corp nor its affiliates or registered investment advisors or broker dealers do not provide investment advice. No communication from Secured Investment Corp or its affiliates, though its website or any of the materials intended to be or should be construed as investment, tax, financial, accounting, or legal advice. Please raise your right hand and repeat after me. I understand the disclaimer, and I will never, for any good reason or bad reason, sue Lee Arnold or any related entities. Amen. All right, good. Let's move on. There is no assurance that any strategy will succeed or that any program will meet any investment objectives. Secured Investment High Yield Fund 2 is open to accredited investors only. Circle of Wealth Fund 3 has filed offering circulars and make additional filings with the Securities and Exchange Commission. While you guys are reading through the rest of those, I'll give you a little commentary on what this is. Guys, we are a private equity fund manager, and we have multiple funds. Some require you to be an accredited investor, which according to the SEC, you need to generate over $200,000 a year in income on your W-2 form. If you are married filing single, single filing single, and $300,000 if you are married filing jointly. Okay, so if you are married filing single, which you can do with your spouse, then each of you would need to be generating $200,000 apiece to meet the qualifications of accreditation. The other way that you can achieve accreditation status is to have $1 million in investable assets, excluding the equity in your primary residence, okay? So if you fit into one of those two buckets, then you are an accredited investor. Some of the strategies that I'm going to be teaching you tonight will require you or the investor that you're bringing in on the deal to be accredited. However, we also have opportunities for non-accredited investors, and that's what our Circle of Wealth Fund 3 is. It's what's called a Reg A Plus fund. You do not have to be accredited. Doesn't matter if you make $4 a year or $4 million a year. You can put money in that fund. Minimum investment is $1,000. But we also have whole notes. So if you want to purchase an entire note yourself, meaning no other investors, you do not need to be accredited to purchase that note. You can buy the whole thing yourself. We offer notes as low as $30,000. So our notes on the low side are 30 grand, up to soon millions of dollars. Now, right now, you guys can go to securedinvestmentcorp.com. I don't think this is on the screen anywhere, but right now you guys can go to securedinvestmentcorp.com and simply click on mortgage notes. There's a tab right there on the front of the website, and you can click on the tab. And you can right now just go through and look at all of the notes that we currently have for sale. Now, these are loans that we've already underwritten, we've already funded them, they're sitting on our private equity lines, and we sell those notes to investors and individuals just like you guys. You can buy the whole note, or if you are an accredited investor, you can buy a portion of the note in $50,000 increments, which is pretty exciting stuff. Okay, so some important definitions for you to know. Now, I know that we are all of varying education levels in real estate and in notes, and please understand, it is not my goal to leave any of you in the dirt. nor is it my intention to leave you seasoned investors feeling like you're not getting any meat, all right? But we always want to start at kind of the base level so we're all on the same page, starting with definition. First definition I want you to write down is note. Also, I want to give you guys some instruction on best practices, at least when you're attending classes with me. I am fine if you want to take a picture of the slide or if you want to do a screen grab of the slide, okay? It's important for me that you guys get the information. That's my priority. So if it's faster for you to just take a picture of the slide, then you don't have to take any notes or write anything, and you can just listen to what I'm saying. So don't feel bad holding up your phone to the computer screen and taking a picture, that's fine. Also, if you want to do a screen grab of the slide, what I like to do when I'm watching webinars personally, I will do a screen grab of the slide and then I'll copy and paste it into a Word document so that I essentially have the entire presentation at the end of the webinar, okay? So 2 tricks you can use for me. It's how I do it. You might want to try that. A note defines the interest rate, the payment, the term, the maturity date of a note, and clearly outlines the penalties of any late payments, okay? So if we're going to buy notes, obviously we're going to need to know what that information is. A mortgage, however, is a document used when a property is pledged against a loan. It will outline the foreclosure rules and identify how you will get your money back. When purchasing a mortgage, an assignment of mortgage is prepared and recorded at the county recorder to transfer the ownership of the mortgage. Now, please understand, you guys understand this. The mortgage is recorded. Oftentimes, the note is not. So we can record the mortgage, but not record the note. So especially when we're going out and looking to buy existing paper, the mortgages are easy to find, but oftentimes the note will not be there and it will be missing critical things like interest rates, payments, terms, maturity dates of note. If those aren't in there, we'll have to get them from the person looking to sell the note. Now, here are 12 reasons why mortgage notes are appealing to investors. Now, what I like to do when I'm presenting is I just open up the entire slide so that you guys can either begin writing if you are a written note kind of a person, or you can start snapping photos, okay? That way you can listen as I'm giving the explanation. So here's why notes are appealing to investors. They can be relatively easy to manage. Unlike purchasing real estate where I'm buying a physical, tangible asset, where I have tenants and I have toilets and I have taxes and I have an insurance and I have damages, when you buy the note against the property, you don't own it. Okay? You're not responsible for fixing the roof or fixing the foundation or putting in a new tenant or collecting rents. All you are buying is the person who owns that property. They have to send you a check each and every month. Now, the thing I love most personally about notes is I have never had any one of my borrowers, and these are on loans that we own, that we control, I have never once had a borrower call me and say, Lee, I'm not going to make my monthly payment this month because my toilet isn't working and you haven't come over to fix it yet. Has never happened, and it never will, because I am not the property owner and they are not a tenant. I am the note owner and they are a borrower. And as long as they send me a check the first of every month, they can continue to enjoy the ownership of that asset. In the event that they stop paying me every month, then I'm going to foreclose, and now I'm going to own that asset, which is not the goal, okay? We are not a firm that does what's called loan to own. Please write that term down. Loan to own is where we are funding and originating and writing paper with the intent purpose of the borrower defaulting. That is not what we do, okay? Now, there are lenders out there who prefer to operate that way. I'm not interested in owning the property. I simply want my monthly payment every month without any phone calls, without any hassles, without any issues, okay? When that happens, it's a beautiful, wonderful business. Also, number 2 here on your list is that the note business offers versatility with exit strategies. Okay, now, if I'm going to sell a property, am I on or is it the slide that's on?
Slides up.
Okay.
Of course.
Can you toggle back and forth to me?
Yeah.
Okay. There we go. Okay. If I'm selling a property, all right, I have to clean it up, list it with a realtor most likely, allow interested parties to go through it and inspect it. I got to get a third-party inspector to go and crawl around in the basement and the attic and the roof, and then report back to the potential buyer all of the known issues or problems. And then I have to make concessions to their funding and their financing. And if everything works out and they're a well-qualified borrower, they can get a loan and now they can buy the house, right? So liquidating a physical property is far more cumbersome than selling a note, right? If I have a note, do we have any binders in here with notes? Can you guys bring me a binder with a note? I want to show them this, okay? Charlie's going to go grab one, and I'll show this to you guys in just a minute. When I sell a note, all I'm selling is the right to receive the monthly payments. That's it, the right to receive the monthly payments. And all you need to know is the servicing history. Did they make their payments on time? Will they continue to make their payments on time? What is the value of the underlying asset that is securing the note so that you know you're going to get paid? Okay? So that's all you need as an investor. Thanks, Charlie.
Yep.
Okay. Now, when you buy a note from Secured Investment Corp, okay, you're going to get a little binder that looks just like this, okay? And inside of it, we have put in all of the due diligence information. Now, I know this is hard to see, but you guys can see all these tabs right here. I'm just going to read off the subject of the tabs, okay? Here's the documents that you get when you buy a note from us. Servicing agreement, lender documents, insurance information, title policy, appraisal, original loan docs, and the original mortgage note and deed of trust as recorded at the county recorder's office. All of it right here in this simple binder, okay? Now, this particular note is on a property in Tipton, Indiana. The loan amount is $159,000. The property that secures the note appraised at $235,000, which means this is a loan to value of 67%, and this note pays 9% interest. So if you were to step in right now to the ownership of this note, I would essentially, you would wire me $159,000, and I would mail to you this binder, including the assignment of the mortgage. That's it. Right? So now I receive your $159,000. I now assign the mortgage to you, and you just purchased the rights. See this right here? You guys can lean in if you need to. You just purchased the rights to receive that amount of money each and every month. Is that coming in clear form? I'll give you the amount. Okay? The amount is $1,192.50. So, the difference between buying a note versus selling a house. Notes are much more liquid, more quickly, okay? So please make a note of that somewhere, that seasoned investors prefer notes over real estate because they are liquid so much more quickly. Now, I would never tell you guys, don't buy real estate, just buy notes. I would never say that, because real estate is a great way to grow wealth, where notes are a great way to grow cash flow in the absence of maintenance and tenants and toilets, okay? Number 3 on this list you're looking at, all of the notes are secured by real estate. Please make a note somewhere in your notes, guys. Do not buy notes that are unsecured. I know that seems like common sense, but you all need to be reminded of it. If that note is not secured against something that cannot move, house, multi-unit, commercial, industrial, if that note is not tied to something that cannot move, do not buy it. Now, certainly we know that you can get a loan on a car. Well, guess what? That's a note. You can get a loan on a mobile home. Guess what? That's a note. You can get a loan on an RV. That's a note. But in the event of non-payment, you have to now essentially foreclose on that note, and now you have to go chase down the car. You have to go chase down the RV. You have to go chase down the mobile home. It's not worth it, okay? So if it's not secured by real property, I would strongly discourage you from buying it. unless you are a seasoned expert, you've got enough capital that you can offset losses, then you can go into some of those riskier things. But for our purposes here today, just stick with the basics, keep it simple, stay safe. Number 4, notes allow you to escape the day-to-day volatility of the stock market. If a note rate is fixed at 9, you will get 9 for the entire duration of that loan. Okay? Now this loan that I just showed you here, this is a 9% rate fixed and it's a 24-month loan. So when you buy this loan, you get 9% return on your money every month for the next 24 months. Did you bring me another one here, Charlie? Let me see this one. Okay, here's another note. Now guys, we originate anywhere from 30 to 50 of these every single month. So there is no shortage of opportunity for you to buy these things. And again, you can go to Secured Investment Corp and see them. Now this note, this is on a property here in Coeur d'Alene. And this note, this property appraised at $300,000. The loan amount is $149.5, so this is 50 cents on the dollar. That's a very good and safe loan, and it's paying 10%, and it is a 24-month term. So if you were to buy this note, you'd be getting a 10% rate of return on your money. You'd get a monthly payment every month in the amount of $1,120, and you would have all of your capital returned in 24 months. Okay? So it doesn't matter if the economy is high or low. It doesn't matter if we have inflation occurring. It doesn't matter what the feds are doing. Nobody cares because the note rate is fixed. It cannot be adjusted. Now some of you are thinking, well, wait a minute, Lee, I've heard about adjustable rate mortgages. You're right. There is such a product. But the terms of the adjustment has to be disclosed at the time of signing by the borrower. So no loan can be adjusted without the borrower's original approval. And if you do adjust it after the loan is signed and recorded, that now becomes a loan modification and it has to be re-signed and reapproved by the borrower. So a note is fixed, can't be messed with. Number 5. Mortgage notes are appealing to investors because they offer a larger, sometimes quicker return than any other type of investment. Again, these are fixed. You guys are stepping into an already occurring cash flow stream. Unlike where you have to go out and buy a piece of real estate, you got to fix it up, clean it up, and then you got to market it, put a tenant in there, and then start collecting your rents. With mortgage notes, if you're buying performing paper, the minute you purchase that note, every day of interest is yours from the day you wire the money. Okay, so it's immediate cash flow, not like real estate where it may take you some time to get that thing producing income. Number 6, real estate mortgage notes, diversify your portfolio. If you guys are heavy in stocks, heavy in your 401k, heavy in self-directed IRA funding or whole life or real estate or crypto, if you guys don't have mortgage loans in your portfolio, I would really encourage you to add at least a 5 to 10% strip to your total portfolio just for diversification reasons. Number 7, there is no need to manage rental property. Again, we're not buying property, we're buying the debt against those properties. Number 8, this allows you the opportunity to earn additional passive income. Because it's not a rental, because you don't have tenants and toilets, because it's not your problem, you guys can buy a note from anywhere in the world. You set it up through third-party servicing, as we do all the servicing on all the notes that you originate and sell. We are the servicer. So if you want us to wire your money to Paris or France or England or Jamaica, great. You just tell us where you're going and we'll wire that payment directly to wherever you are. So you can be anywhere you want to be. Allows you to be very mobile. You get to choose the yield. You guys do not just, well, here's $100,000 and hopefully you'll give me a return. When you buy that note, the interest that you're going to earn is fixed from the moment you buy it. So if you don't like the yield, don't buy the note. Or if you like the note but you don't like the yield, ask the seller if they'll take less for the note. For example, this note is $150,000. It pays 10%. And you say, well, Lee, I really want to get 12% return. So I'll only pay you $120,000 to buy your note. Now, the payment doesn't adjust. If a buyer purchases your note for less than the face value, they earn a greater yield on the investment because the note rate is fixed and they simply paid less for the loan. Now, before anyone asks, Secured Investment Corp does not sell its notes at a discount, okay? So don't ask. The answer is no. But there are private sellers who will sell their loans at a discount. Here's a great example. Not too long ago, I purchased a note. Guy had sold his house. He had been servicing the note for 10 years. It still had 20 years left of payments. The payoff on the loan was $160,000, and I bought the note for 60 grand. Why would anybody sell a $160,000 note for $60,000? Because he wanted the 60 grand. He didn't want the $1,000 a month for the next 20 years. So there's all kinds of reasons why somebody would do that. Number 9. What are we at? Target yields. Let's see here. Number 10. Notes are IRA friendly. So for those of you that have a self-directed IRA, notes are IRA friendly. Many of the notes are non-recourse, so you can buy them through your IRA with no issues whatsoever. Number 11, provides an opportunity for socially responsible investing. You guys get to choose what you're investing in. So if you want to buy notes in areas where people are purchasing rundown houses and you can retrofit them and improve them, then your investment is cleaning up communities, possibly solving homelessness in some markets. You get to decide, 100% your decision. And then lastly, it always allows you to purchase notes, or it allows you to purchase notes at a discount. Not always, but in many instances you can buy notes at a discount, okay? All right, 4 types of loans to be aware of. Secured loans, secured against anything, preferably real property. Unsecured loans would be loans on like credit cards, personal loans. An institutional loan is going to be a loan from Fannie, Freddie, VA, FHA, conventional mortgages, USDA, and then of course we have private loans. Now, private loans are any loan that is not FDIC insured or backed by any institution, okay? So, Secured Investment Corp, because we're a private equity fund manager, all of the money that we manage is from private investors. We fall under the private loan designation, and we are all secured. So every note we write is secured, okay? So some note purchasing terminology. Please take a photo of this one. Loan purpose. Is it a purchase or refinance? There's really only 2. So when you guys are looking to buy a loan, was this a purchase or a refinance loan? Is it owner-occupied or non-owner-occupied? Please make a note in your records there. If you can, you should be looking specifically for non-owner-occupied loans. Now, non-owner-occupied loans come with a lot less red tape. They are easier to foreclose on. There is less chance of litigation. And because of that, most of your foreclosures will be uncontested because you're not dealing with an owner-occupant. If it is owner-occupied, understand that the laws of the land favor the homeowner. And so if you buy a note that is owner-occupied and you have to foreclose on it, it could take you, if they get a good attorney, it could take you anywhere from 48 months to 7 years to foreclose if it's owner-occupied. If it's non-owner-occupied, even if they fight you and contest it, you can usually get the property back within 12 to 18 months, okay? So personally, I do not want to be buying notes that are owner-occupied. I want non-owner-occupied notes as often as I can get them, okay? Thirdly, every note that you buy should come with the market or appraisal value that was obtained at the time of origination. And if that note is aged, meaning the loan is 5 years old or 10 years old, before you buy it, you need to get a new third-party opinion of value. Now, this could be something like House Canary, which is a great website for valuation tool. You could get a BPO, which stands for Broker's Price Opinion. This is where a local agent will go out and give you their opinion of value. You always get a third-party opinion of value before you purchase paper, all right? Next one, after repair versus as-is value. Is the value assessed by a third party based on an after-repaired project or a property value as it sits? So am I buying a note? Did the person that purchased that property, Am I buying a note that they just bought it as it is and they're not going to do anything to it? Or am I buying a rehab loan where they bought it for $100,000, but now they need to put $80,000 in it to make it worth the $400,000 valuation that it says it has? I don't know, but you're going to want to check that. What type of a loan is it? Is it as is, or is it after repaired rehab loan? Okay. Next one, loan to value. This is the loan amount divided by the market value. For example, a loan amount of $100,000 divided by a value of $200,000 is a 50% LTV. Now, I want you guys to write this number down. This is a baseline. You never want to buy a note where the LTV exceeds 70% of the fair market value. Please write that down, okay? Do not buy paper that exceeds 70% of the fair market value. Also, do not be lured in by lower mortgage amounts that are often second liens, and I see a lot of novice investors buy these because you can get a 15 or a 20% yield, which is a great return, not realizing that this little $20,000 note that you're buying is sitting behind a $200,000 first mortgage. And when you combine the two together, 200 plus 20 is $220,000, and the house is worth $250,000, that is a very, very risky loan to be in. So watch your loan to values very closely. Do not buy paper that exceeds 70%. You guys will be happy to know that as a company, we do not originate loans above 70% loan to value. So if you're buying notes from Secured Investment Corp, you can know that a lot of these benchmarks that I'm giving you, you don't have to worry about it because we're already doing it. But I know that a lot of you are going to take this information and go out and look to buy notes from other sources or to buy notes from direct from seller. And you got to know some of this stuff just to make sure you don't get yourself in trouble, okay? The best thing I can tell you, if you're going to buy a note from me or anyone else, please call my office before you close on that deal and let us just look at the note and make sure that you're not getting yourself in a bad spot because we don't want you guys losing principal. That's the worst thing as an investor that can happen. We are happy to review your notes and look at them. No charge. I just want to make sure you guys are protected. All right. Next one, rate of return. The rate an investor can expect to earn on their investment. Now on this one, I want you guys to highlight the word expect. The rate of return the investor can expect to earn. Now by expect, that's the face value of the note that I was telling you about, right? So again, this is paying a 10%. So if you were to buy this loan, you can expect a 10% return. However, if the borrower, for whatever reason, stops making their payments, then you can't expect a 10% return because they're not paying you. Now, as a company, we have a 7%, please write these numbers down. We have a 7% default rate, which means if I originate 100 mortgages, 7 of them are going to have slow payments, meaning they're going to go 30 days, 60 days, 90 days late, but our servicing team is going to call them and work with them to keep payments coming in. So that's what a default is. Now, if we are unsuccessful in doing a workout in the default stage, then we're going to have to take that property all the way to foreclosure sale and we will own it as what's called an REO. Now, our portfolio rate on REOs is just 3%. So if I write 100 loans, 7 of them are going to have challenges in getting their payments made, but we're going to get them paying. But 3% of those, or 3 of those properties, we're going to have to take back through foreclosure. Now, when you guys are out shopping and potentially looking to buy notes from any other lender, one of the questions I would ask at the very beginning is, tell me about your portfolio performance. So it's great you've originated a ton of paper, but I want to know, how does your portfolio of loans perform? Now, if I'm at 7 on a default and 3 on an REO, if they go, well, you know, we're running about 12% default and we got a 7% REO rate, buying loans from that provider is going to be riskier for you than buying them from me. Now, if you call another provider or another originator like me, and you say, hey, tell me about your portfolio performance, and they say, well, we're operating at a 3% default and a 1% REO, then clearly they've got less risky loans. Does everybody understand this? Makes sense, right? Okay, I will tell you that 7 and 3 is better than the industry standard in private money. So we are a very good originator and we are a very good servicer. So if I'm going to originate paper, I believe in that borrower, I believe in that project, I believe in that person's ability to pay, and I have the same belief when I transfer that note to you if you are the buyer of that paper, okay? Exit strategy. This is the next question you should be looking at when you're buying paper is how is this borrower going to get me my money back? Okay? There are 2 questions that every investor always will ask. Please write these down. Question number 1, what is my return on investment? So what's my yield? Okay, every investor wants to know what's my return on investment. Here's the second question, and this one's actually most important. When and how is my return of investment? Okay? How is this borrower going to take me out? Are they going to flip the property? Are they fixing it up to sell it? Are they going to wholesale it out? Or are they buying it as a rental? And if they're buying it as a rental and I've only written 12 or 24-month paper and they're going to refinance it to a conventional lender after they get it renovated and fixed up, here's the question. Will they qualify for the takeout financing? Do they have ample credit? Do they have ample income? Are they reporting on their taxes? Have their taxes been filed? If the takeout strategy or the return of your capital is through a takeout refinance, before you buy that note on the front, you better make sure that they qualify to take that loan out on the back. Otherwise, you're going to get stuck in that loan because it's a 12 or 24-month loan that they plan on holding as a rental, but they can't refinance it, so you got to just keep going along for the ride. So most investors are going to want to get their principal back out of that deal eventually so that they can put it into another opportunity. So how are you going to take me out of this deal? That's the question. Next one, hazard insurance. All of the loans that we assign, you guys will be placed on the insurance binder as the loss payee. So Secured Investment High Yield Fund 2 will be a loss payee, and you as the buyer of that note will also appear. We will transfer the insurance so that you are the loss payee. And that's the other cool thing about notes. Not only you're protected because the loan is secured against the property, but if that thing burns down, the insurance money goes to you. And that's how you can recover your investment, even in an act of God scenario. Fire, flood, tornado, hurricane, all of those things, you are covered as the lender because you're the loss payee on the insurance policy. Okay? Second to last, title insurance. All of our loans come with title insurance to ensure that our loan is in first trust deed position. Please write that term down. Do not buy junior liens. Okay? Buy first trust deeds only, unless you know the first lien holder. Okay? Now this is what we call a friendly foreclosure, where I've originated the first and I'm in a first position, and I've originated a second which I'm going to sell. Okay? Now if I sell off that second position and the borrower defaults, rather than me foreclosing and wiping you out in a junior lien position, we're going to work together to foreclose on the borrower who's not paying us, and then we're going to share in the proceeds from the sale. Okay, that's what's called a friendly foreclosure. So do not buy a junior lien position unless you know who the first lien holder is and you have a friendly foreclosure arrangement with them. Otherwise, you're at risk of being wiped out through the foreclosure sale. All right? And then lastly, we covered this briefly, the lien position, the order in which creditors are repaid in the case of foreclosure. Again, buy first and then you don't have that problem. All right. Next thing, you can buy performing loans and you can buy non-performing loans. A performing loan is where the owner of the home makes monthly payments and has done this for an extended period of time. It's great for generating passive monthly income from cash flow, and there is significantly less risk that comes from the potential return. So if you guys are looking for a pretty consistent, reliable, predictable income stream, you're going to want to buy performing notes. If, however, you are a little bit more risk adverse and you're looking to get 20 and 30 and 40 and 50% rates of return, the opportunity to do that is going to come in the non-performing side. The homeowner stopped making payments. If the payment has been made in the last 30 days, it's considered non-performing. This is a good opportunity to work with the homeowner. You can get the loan performing to resell or foreclose. The upside is in selling the note of being paid off because these are typically bought at a discount, and higher risk comes with a higher potential return. Now, somewhere in your notes, I want you to write down the following statement. Non-performing loans should be purchased between 40 and 60 cents of the face value of the note. Example. It's a $100,000 mortgage. Borrowers stopped paying. Person who funded the deal wants to get out. They're like, I don't want to take this guy through foreclosure. I'm willing to sell that paper. You should be buying that $100,000 loan between 40 and 60 grand. So when I say 40 to 60% of the face value of the note, you should be paying 40 to 60%. Now, do not make the mistake of going, well, wait a minute, Lee, that's a $200,000 property, and if I foreclose on this $100,000 loan, I'm going to get the property, so I'm going to pay $100,000 for a $100,000 non-performing mortgage. Well, understand that when you buy a non-performing note or even a performing note, you are only entitled to the face value of the note and any accelerated interest costs, missed payments, attorney's fees. That's all you get. And if you take that property to foreclosure auction and a third-party bidder outbids you, all you're going to get is the $100,000 that you paid for the note. So make sure you understand this. When you buy a note, you're not buying the property. You're buying the right to receive the debt that was agreed to be paid against the property. But also somewhere in your notes, please write this down. To generate 40, 50, 60% rates of return on capital, it's going to be achieved through non-performing paper. And here's why. I buy the $100,000 note for 40 grand, right? I invest $10,000 on foreclosure. I now get the property back, or the property sells at auction. So let's say that I open the bidding at auction at $50,000 and it gets bid up to $100,000. Well, I'm entitled to the first $100,000 of the proceeds from the foreclosure auction, so I just made a 100% return. I got 50 in the deal and I just got a check for 100 grand. That's a 100% rate of return. That is not going to happen in a performing loan scenario. So like I said, if you are risk adverse, meaning you're fine foreclosing on somebody, you're fine taking back the asset and disposing of it, then non-performing paper is a huge, huge opportunity. Now, what most people don't know is that at Secured Investment Corp, we will sell you our non-performing paper. So if you would like to pursue these higher opportunities for yield, guess what? We'll sell it to you. Just go to our website, securedinvestmentcorp.com, look on notes, and then you're going to want to look for specifically for non-performing loans, okay? A lien refers to a claim by one person on the property or another for payment of the debt. The lien provides security for your investment, typically used as collateral to satisfy a debt. Now, what does a lien determine? A lien determines the order of who gets paid in the event of foreclosure. Mortgages in a first lien positions have the highest claim, and loans created after the first position are considered riskier investments. These are referred to as second position, third positions, and so on. Now, great news, you guys. In just a moment, I'm going to be giving you actual case studies with pictures of actual houses and actual numbers and actual deals. So for those of you that feel the tops of your eyelids getting heavy because this is a lot of information, bear with me. We're going to get to the good stuff, the actual income producing stuff here in just a moment. So the investment strategy. How much cash do you have to deploy and what kinds of funds are you looking for? Are you looking for cash flow? Or are you looking for long-term investment strategies? Are you specific about the location of the property? Are you willing to buy properties in any part of the country? And then what is your contingency plan if the property were to go into default? You guys should answer all of these questions to really truly nail down and solidify your investment strategy. Now, real estate note investing. This is where we're going to use mortgage notes to create passive income and massively increase this, okay? Now, these are, as I mentioned, we originate short-term loans, 6 to 24 months in length. Our minimum loan is $30,000 up to $2 million. They're secured by a first lien position and a personal guarantee. We collect interest-only payments. We do not do PITI payments. Please write that term down. PITI stands for principal, interest, taxes, and insurance, okay? We do not do PITI. We simply do interest only. So we do not collect monthly for taxes. We do not have escrow impounds for the insurance. All of the taxes and insurance are paid at the front of the loan. And if it is a 2-year loan, we collect the property taxes and the insurance for year 2, so that we don't get in a situation where the borrower's making payments to us, but they haven't paid their property taxes, and then our position gets wiped out through a tax sale. Again, guys, I know this is a lot of information, but let me see if I can make this real simple, okay? If you are buying notes from Secured Investment Corp, you don't need to know any of this because we've already done it all, okay? So you can have great assurance and confidence when you're buying our paper, because everything that I'm telling you is best practices is how we originate and underwrite our paper. So buy Secured Investment Corp paper. It's the safest paper. It's the best paper. It's done the best. It's underwritten the best. And I know that that sounds really arrogant, but if I'm going to be writing somebody a check for $200,000, I would want them to be extremely confident about their product and their process and what they do, because I want to know that they know what they're doing and I can rest assured that I'm going to get paid. Interest-only payments. We only lend, okay? When you go to our website, you're only going to see notes against single-family, duplex, triplex, and fourplex properties that are non-owner occupied. We don't originate on commercial, we don't originate on industrial, we don't originate on warehouse, and we don't originate on land. The reason we don't originate on land is this reason, okay? Everybody stop what you're doing and pay attention to this right here. Everybody ready? A little riddle for you. What do you call a private money lender in a recessionary downturn, right? So the stock market crashes, it's 1929 all over again. We've originated all of these loans. Pandemonium is happening in the streets. It's a Wonderful Life is becoming a real scenario. Banks are failing. What do you call a private money lender in that type of an environment? The answer? Landlord, okay? In the event of default and complete destruction of the United States economy, people still have to live somewhere, right? So they can't make their payments. We end up owning the property, and now we're going to rent that property out. We're going to go from being the lender to the landlord, which we don't want to do, but in a worst case scenario, that's exactly what we're going to do, because now we can generate income by renting the property out, and we can collect income that way. We'll wait for the economy to sort itself out, 1938, 1939, and then we can resell the property and originate new paper. So the answer to the question, what do you call a private money lender in a recessionary downturn? Landlord. And that's why we don't originate loans on land. Because in a complete meltdown, nobody's going to pay me to sit on the land. So it's very hard to get land to cash flow in the absence of extreme investments, development costs, governmental red tape in getting approvals and permitting, and it's a mess. And I would discourage you guys from buying notes originated and secured against land for the very same reason. What most people don't know, because I don't share this often, is that my parents have money invested in my firm. And so I'm never going to originate a loan and sell it to you that I would not be willing to put my own parents' money in the deal. And that's kind of the qualifier is, if I wouldn't put my own money in that deal, you're never going to see it displayed on my website and available for sale, because if I don't believe in the borrower, we're not funding that note, okay? We originate loans for purchases and refinances, and newly originated loans that have been fully underwritten, vetted, and pre-funded. Collateral files should contain the following documentation. Now, this is really important. Please take a picture of this slide, because if somebody comes to you and says, hey, I got a note, do you want to buy it? you're going to say the following: I may be interested in purchasing your note, but I'm going to need you to send me the mortgage, the note addendums for the transfer, the assignment. I need the title policy. I need the final HUD to show when you funded the deal. I need the allonges to the note. These are the transfer documents. I need the assignment of the mortgage deed of trust, and I need the payment history through the third-party servicer that is collecting the payments on behalf of the borrower. Now, if you ask those things from me, I'm going to send you this binder because all of those things are included in every note that you buy from us. However, if you buy notes from somebody else, you better be able to collect these documents. Now, to manage your expectations, we have requests come in every single day to our company of people wanting to buy their note or buy their notes. When we ask them for these things, less than 1% of the leads that we produce can actually procure and provide these documents. That's frightening. I mean, it really is. It's frightening because if they can't produce these documents, it means they never requested them or got them when they originated the paper in the first place. So while note investing is like the coolest thing ever and one of the most profitable income streams that I have personally, man, there's a lot of garbage out there. And so you guys need to know how to sort through it. And if they can't produce those documents, do not even waste your time trying to build them. It is not worth the effort, okay? So how does a trust deed and note investing work at Secured Investment Corp? Well, the loan underwriting and origination, the capital fundraising, the loan servicing, tax reporting, statements, foreclosure process if required, property management, and sale are all done in-house, okay? We do it all. Second, these loans are typically short-term. We don't originate loans longer than 24 months that we make available for sale to you guys. All of our loans are 12 to 24 months. During that time, you will be earning a monthly fixed income, which historically averages between 8 and 11% annualized interest, sometimes more, sometimes less. Now, please write this little nugget of info down. This is the secret sauce. Typically, the lower the loan rate to you, the investor, the safer the file, okay? So if you go to my website and you see a note that's offering like a 6 or a 7% payout, the reason it is, if you go in and look and research that note on my website, you're going to discover the reason we're only offering to give you a 6% rate of return is the borrower has like a 780 credit score. They made $400,000 on their tax returns last year. They plunked 50% of the purchase price down in cash, which we sourced through their bank accounts. There's no way on planet Earth that that person is defaulting on that loan. So you have to ask yourself the question, do I want like as close to a guarantee of payments as I can get at 6 or 7 because there's so little risk involved in that file that I'm willing to earn a little less on my money? Or am I willing to roll the dice? Am I willing to go, well, you know, okay, so their credit's not great. They didn't put a whole bunch of money down, but I like the asset. I like the location. And so I'm willing to get 12. We have loans. We have a loan right now on our website, guys, that pays 13.5% interest. 13.5% interest. Wow, that's awesome. But high risk, high return. Low risk, low return. So you guys have to come up with your own risk tolerances to say, I'm willing to roll the dice to get 13, or I don't want to deal with it. I'm fine getting 6. Now, my wife and I, who are married filing separately. We're happily married 22 years, but for tax reasons, we are married filing separately because this creates 2 separate buying entities within the same household. So my wife has her own portfolio of real estate and stocks and bonds and mortgage notes, as do I, but she has a very low risk tolerance. So she will not buy a note that pays over 8. She's like, give me 8. I'm happy with 8. 8 is great, is her motto. Me, 8 sucks. 8 is like terrible. I don't want 8. Give me the 13 because I have a huge risk tolerance and I'm willing to go through the process of foreclosure to get 13. And if I take it to foreclosure, I'm probably going to get 20. But again, it's not set. It's your decision. You decide, what am I comfortable having to deal with to get this yield? And 8 is great is not a bad motto if you are more risk adverse than some others. For each note purchased, transfer docs are drawn up and recorded on your behalf. You will receive a recorded assignment of mortgage deed, an assignment of the promissory note, title insurance, and liability insurance. You'll get this binder shipped out to your house, and everything you need to know about this note will appear. Can you come to me, Peter? Everything in this note will appear, and then when you put it in your bookshelf, the spine will tell you all of the pertinent information about the note. So when you put this in your bookshelf, you will see that this loan is paying $1,200 a month. You can see the date of maturity, and you can see the property address. So we have some of our investors that have bought hundreds of these loans, and I love doing Zoom calls with them because when I look in their bookcase behind them, it's just binder after binder after binder after binder after binder, and some of them own millions of dollars worth of notes. So you could just go to their bookshelf and say, okay, he's getting $800 a month on that one, $1,200 a month on that one, $2,200 a month on that one, $1,800 a month on that one. Holy cow, this guy's getting like $20,000 a month in mortgage payments from the notes that are sitting in his bookshelf. Pretty exciting stuff. And here's the other cool part. As I mentioned at the top of this call, if you bring us an investor who is willing to earn 8 and you help them buy a loan that's paying 10, they get 8, you get 2. So if I were paying you 2 points on this loan, for example, so this loan is paying 10%, right? So you bring in an investor who buys this note. Your agreement with them is that they get 8, you get 2. Out of this payment, you guys are going to get $2,200. You're going to get $224 a month for the next 24 months, simply for referring that investor in and helping them buy this note. We will service the loan. We'll collect the 10% payment from the borrower. We will send 8% to your buyer, and we will send 2% to you. That's what's called sub-servicing. Please write it down. If you guys are not utilizing sub-servicing as an income strategy within your business, you're missing out on a huge opportunity. You guys could literally have 2 nickels to rub together, and you could go out and sub-service a couple $1 million worth of mortgage paper, and you could be getting checks for $3 and $4 and $5 and $8 and $12,000 a month on paper you don't even own, with money you didn't even have. Pretty cool stuff. Now, what does Lake City Servicing do for you? Well, we are going to collect and disperse your monthly payments. We're going to monitor the hazard insurance to make sure that that continues to get paid. We're going to monitor the property taxes to make sure that those are never in default or in delinquency. We're going to deliver the end of year tax reporting on all of the income that you've earned from that note. We're going to provide lender with all the original documentation. And in the event of default, we're going to work to collect on behalf of that borrower to get you your money. We will negotiate loan modifications. We will negotiate workout agreements. We will negotiate short sales on your behalf. We will work with local agencies to get the property listed if you end up taking it back through foreclosure sale. We do it all, okay? So all I need you guys to do is go to my website, pick a note, let me know you want to buy it, wire me the money, I'll take care of all the transfer documentation, I'll ship you the binder, and then I'll just start sending monthly payments to you. That's all I need you to do. And if the note goes sideways and we have to foreclose, now my Lake City Servicing team is going to be communicating with you and basically presenting you with a list of options, and you simply tell us which option you would like to take. Pretty simple. So what are the risks? Lee, this sounds amazing. What's the downside? Well, here it is. The borrower could default. You may have to foreclose. The project might take longer than you expect, and so you thought they were going to pay off at the end of the year. Turns out we got to give them a 12-month extension because the project is taking longer due to government red tape. They couldn't get permits. Who knows? There's a million reasons why it could take longer. You just need to be prepared for it. But in any case, Lake City Servicing, as long as we're servicing that loan on your behalf, we're going to manage that whole process for you. Okay? So here's the life cycle of note investing. This is what you guys need to be aware of as it relates to the process. Number one, you need to identify the potential deed or note that you would like to buy. Again, you can buy them on our website. You can go to another website called PaperStack. They've got loans for sale. Eddie Speed over at Note School, he sells loans. So there's loans for sale in various places. You guys can just simply Google notes for sale, and it'll take you to a plethora of websites. But you need to identify the potential deed or note that you want to buy, and then you need to perform your due diligence, which means you again need to be asking for that list of documentation that we provide here. You need to collect that from whoever it is you're buying the note from. Do your due diligence. If you like what you find, invest. Digitally sign the documents securely online. Make sure that all of the necessary recorded documents get recorded. Wire your transfer and then begin earning that monthly payment. And then at the end of the term of that loan, whether it be 12 or 24 months, the borrower repays the loan, you get your capital back, and now you need to redeploy it. Now, on any given month here with Unsecured Investment Corp, we will have anywhere from, I think on the low side, we might get $500,000 to $800,000 in loans that come paid off in a month. Other months we'll have $8 to $10 million worth of loans get paid off in a single month. And many of those investors, we have investors that have been buying paper with us for over 20 years. And so when they get their loan paid off, I mean, they're back on our website shopping because they want to get that money redeployed. The worst day in the life of a lender is when they get all of their money back, right? Okay, I put out 100 grand, I've been earning 12%, that's 1% a month. I've been getting a check every month for $1,000. 12% is 1% a month, so $100,000 investment, I'm getting $1,000 a month in income. And then suddenly out of the blue, I get a check for 100 grand. And now those $1,000 a month checks suddenly stop rolling in. So now I need to get that money redeployed into a performing asset so I can get the income stream coming again. The worst day in the life of a note investor is the day the loan pays off. I got to redeploy it. And so a lot of our investors will just say, hold my money, don't send it back to me, just keep it in your escrow accounts. They tell us which loan they want to buy and we'll just reassign their money to another loan, and they're off to the races and their money just keeps performing and keeps producing. Guys, we have paid out millions and millions and millions of dollars in monthly note payments to investors all over the nation and for really all over the world, because we have note investors who will buy paper and then they'll move to Costa Rica or the Dominican Republic, or they'll go on vacation for 6 months. Snowbirds love us because it doesn't matter if they're living up in Wisconsin or living down in Florida, we just wire the money directly to their bank account. They don't even have to cash checks. It's a great, great option for everybody. We do recommend, if you have one, investing in these notes through your self-directed IRA. Because if it's in your IRA, then the income that you're earning is tax-free. And tax-free money is the best money you can make. Because now, if you think about it, if you're doing this through your self-directed IRA and you're getting that $1,000 a month tax-free, imagine doing that $100,000 note through your bank account, where you're now going to pay 30% tax on your income. You're not making $1,000 a month, you're actually making $700 a month. So that 12% note rate, it's not actually 12, it ends up being like 8 after you pay taxes. If you do it in a self-directed IRA, all of that income is tax-free, no taxes. It's like a 30% bump in income. And if you guys don't know about self-directed IRA investing, you need to get one. We have several that we recommend. Equity Trust is a company that we do a lot of business with. Alto IRA is one we do a lot of business with. Mountain West IRA, we do a lot of business with them. Who are some of the others, Charlie? Camaplan. There's Preferred Equity Trust or Preferred Trust or something.
Yeah.
Google self-directed IRA investing and you're going to get a laundry list of custodial firms, but the ones I mentioned are the ones I would recommend. Equity Trust, Camaplan, Mountain West IRA, Alto. These are some that we do a lot of business with and we have a great history with them and they know our process and we know theirs. With a self-directed IRA, you can invest the funds in assets such as real estate, non-traded businesses, even a horse farm. You will need a trustee or custodian that specializes in these type of investments, and you might get high returns and portfolio diversification, but there are risks. However, it is tremendous wealth creation. You get diversification outside of the public sector. There's potential tax savings. You can invest in things that you know and understand. With mutual funds, most investors do not know what assets they're investing in. You can target compounding growth from reinvestment of dividends, and you can borrow money from the IRA to take advantage of other investment opportunities where you are leveraging the amount of money that you have in your IRA to purchase properties greater than the amount you actually have. You can lever an IRA, but please understand that it will trigger something called UBIT, okay? UBIT, UBIT tax. So be aware of that. Talk to your custodial firm about it, okay? Now, my kids have self-directed IRAs. Now, I have boy-girl twins that are 17, and I have a son who's going to be turning 16 next month. He's very excited to start driving. Meanwhile, his mother and I are terrified that he's going to start driving. But it's going to happen. It's just the way the world works. But they are investing in mortgage notes through their what's called a CISA account. Please write this down. CISA stands for Coverdale, so that's a C. Coverdale Education Savings Account. Coverdale Education Savings Account. It is a self-directed IRA for kids who are under the age of 18. Administered by you, their custodial guardian or parent. You can direct your kids' college fund into these types of investment returns. All of their earnings will be tax-free, and they now can use those funds to pay for college, for tuition, for housing, for books, for food, for living expenses, all tax-free. My kids who are 17 have had CISA accounts from the time they were 3 years old. So we've been putting money in their CISA accounts for 14 years, investing in those CISA accounts for 14 years. Happy to report we will not be coming out of pocket a nickel to cover college tuition. Now, well, Lee, what if they don't go to college? Well, that's the beautiful part. If they don't use the CISA account for college, at the age of 18, we can roll it into their own self-directed IRA with no tax consequence. So think about that. Setting up your kids, your grandkids, nephews, nieces with this type of an opportunity could set them up for life. But let me caution you here. Don't just give them the money, all right? Teach them how to make the decisions and do the investments themselves, okay? So show them, hey, here's 3 notes. Which one would you like to invest in and why? Teach them how to do the due diligence. Teach them what questions to ask so that you're not just giving them a fish at the age of 18, you're teaching them how to fish. Now that self-directed IRA for them at the age of 18 now, they can continue to build that through your instruction, and by the time they are at retirement age, they can have up to $4 million in there, all tax-free. Now, I am not a big believer of leaving children trust funds of millions of dollars with absolutely no instruction or education on what to do with it. I think that is a critical error that a lot of successful, wealthy people make, is they leave an inheritance to their kids, but they don't teach them how to manage that inheritance, how to invest those inherited dollars so that they can continue to provide for the family. Most people that get an inheritance spend it within the first year. Luxury vacations, nice cars, and before you know it, the inheritance is gone. That, in my opinion, is not leaving your children an inheritance. And I'm not a fan of that strategy. So this I like. I'm showing you this deal because this is a house, or I should say a note, that my kids' CISA accounts are in, and both my wife and I's self-directed IRA accounts are in, because you can partner multiple IRA accounts. So if you don't have enough money in your account, you could partner with your wife's account, your life partner's account, your kids' accounts. You can partner them together. And now, instead of owning 100% of the mortgage note, my wife owns 40%, I own 30%, and my kids each own 10%. And that's how we get to the 100% of the purchase price of that note. Here's what that looks like, okay? This is a $94,000 loan. The borrower put 24 grand down, so it's a relatively safe loan. It's written at a 55% loan to value, and it matures January 31st of 2025. It's paying 8.49%. So again, 8 is great. You can tell my wife directed this one. If I directed this one, that would be like a 13.49% return. We escrowed $81,000 for rehab, and the person we lent this money to is buying it, fixing it, and then they're going to flip it for a profit. Some other interesting information about the borrowers: they've paid COGO off 3 other times. They've got leased properties producing income. They brought $23,000 in as a down payment. They have a job outside of real estate for the last 12 years, and they live in the very city that the property is located in. Some of the things they're going to do: they're going to fix the fencing, do more insulation, replace the roof, replace gutters, siding, stucco. A lot of work going into this property, so it's going to be worth significantly more after they get done with it than it's worth now. So very secure, very safe note, again paying 8.49%. So here are some other successfully funded deals. Here's one in Indiana. Here are the details of that. This one matures in April of 24. It's paying 9.99%. So this is a loan that you could buy right now today for 63 grand. This borrower brought $31,000 down. This house has a market value of $90,000, and they bought the home for $10,000. So this is a very low loan amount. We have escrowed all of the funds for rehab. So $64,000 of the loan is sitting in rehab to cover the rehab. And some of you are looking at this going, well, wait a minute. The loan amount is 63. How come there's 64 grand in rehab in the escrow account for the rehab? Well, because they brought 31 grand down, because the rehab is going to be greater than the loan amount. So they brought money down, which makes this an even safer loan. Now, here is the before. Here's what it looked like when they were done. Here was the before. Here's what it looked like when they were done. So you guys can see the extreme transformation that is occurring in these notes. Now, the other thing I want you to consider: look at what your investment dollars did to improve the quality of this neighborhood. Not just the house. You have to think about the whole neighborhood, because this was a rundown house that had a fair market value of 10 grand. Now it's this beautiful renovated house that is going to attract a family that's going to go out and get a 30-year conventional loan, which is going to create stability for that household. Look at the before, look at the after. Pretty incredible. Guys, this is what your funds are going to create. I mean, if you don't get just extreme satisfaction from investing in things that are improving communities, providing affordable housing to areas all over the nation, providing safe housing for families, I mean, I don't know what you're going to do. This is like one of the most fulfilling ways to invest your investment dollars that I personally know about. Here's one in Chattanooga, Tennessee. Here are the terms of this loan. Appraised at $212, the loan amount $148. They bought it for $99. We've escrowed $48,000 for rehab. Here's the before, here's the after. Pretty amazing transformation. Here's the before inside, here's the after. Did a great job on the remodel here. Here's the before, here's the after. Look at this transformation. As you guys are looking at these photos, you should be having like glimpses and reminiscent thoughts about watching HGTV, right? Oh my goodness, that's what Chip and Joanna Gaines do. That's incredible. Well, where do you suppose Chip and Joanna Gaines and other people on HGTV are getting their money to do these types of projects? From us. We're originating the paper. They're getting the funds they need to do the renovation. You guys are buying the note that is secured against that property. So you guys, did you realize that you're making HGTV happen? Isn't that cool? So the next time you watch HGTV, you could go, hey, I own the note on that house. That's pretty sweet. Same idea. So please take a picture of this slide. This is the process, okay? So from start to finish, these are the steps. So how much are you looking to deploy? Find the property you're interested in. We'll send you the package, the full loan package. Guys, you get to look at all of our due diligence and all of our underwriting criteria before you buy the loan. So I will give you access to everything in this binder before you buy the note. So all of this is available to you. You don't have to make a commitment. You can see it right now. Do your due diligence. Let us know how you want to fund it, meaning, do you want to fund this with cash? Are you doing a loan against 401k? Are you doing it out of a self-directed IRA? Are you getting a home equity line of credit against your primary residence to do these deals? You let us know. We'll accommodate the flow of the income, okay? We will do all of the necessary paperwork. You, then the IRA custodian will wire funds to our escrow account. Your interest starts the day after we receive your funds. We get you set up with Lake City Servicing. Lake City Servicing will contact you with a welcome call for first-time lenders, and then Lake City Servicing will send you a binder with all of the original documentations for your records. Everything done for you. Now, I mentioned some available properties. Again, you can go to Secured Investment Corp and you can see all of these. Here are just a sampling of some that you could purchase or invest in right now. Now, again, we are live. So if you're watching this video at a time that we are not live, these loans that I'm showing you now may not be available, but just go to our website. We're always adding new loans. We're closing loans every single day. So just go to our website. And I would encourage you guys to set up like a bookmark for our website. And you can also set up a reminder. So if you tell us what type of notes you're interested in, every time we fund a loan that meets your criteria, we'll send you an alert. And you can go, oh, wow, cool, here's a new note that fits my criteria. I should look at that. So you guys will work with our funding team, our investor relations department. They are the ones that will facilitate and work with you on all of these note acquisitions. And I'll give you their contact information here in just a moment. So don't leave. You're going to want to have that. But you can set up alerts right on our website. And any note that fits the criteria, the LTV, the yield that you're chasing, or a particular area of the country that you want to invest in, will notify you every time we have a note that meets those criteria, okay? This one matures on February of 25. Appraised value of this asset, $235. The loan amount, $139.5. They bought it for $63. We're holding back $60,000 in rehab. This borrower has this is the tri-merge credit report. They got a 763, a 739, and a 737 credit, so very well-qualified borrower. They have done deals with us before. They've paid off loans. They've already sold properties. They've sold 12 fix and flip deals. They have 4 leased properties. So this speaks to experience. They've done it before. You're going to have a great experience with this loan. Here's one in Inglewood, Florida. This is a 3-bedroom, 2-bath, 1,500 square foot property that appraised at $370. We wrote the note at $245. There is a target return on this one at 9.99, so that's what your payouts would be based on. We're holding back $30,000 in rehab on this deal. Borrowers have great credit. On their 2022 tax returns, they made a combined income of $262,000, so they are a well-qualified borrower. They purchased the property for 2020 and for $220,000 in November of 23, and they are also a one-on-one student with the Lien Arnold system of real estate. Back to me for a minute, Peter. Something else that I want you guys to be aware of is that we are a nationwide education company. You can go to the Lien Arnold system, just go to lienarnoldsystem.com, and you can see all of the different classes that we teach here at our company. So one of the ways that we produce new loan volume is to the people who go through our educational programs. So we offer fix and flip training, we offer wholesale training, we offer mortgage loan origination and brokering training, we offer sub-2 training, teaching people how to buy properties subject to the underlying. We offer a cash flow training where we teach people how to purchase cash flowing real estate investments. And so all of the classes that we teach show people how to go out into their respective markets and find really good investment opportunities that we will lend them money on. Now, yes, our classes cost money, but here's the cool thing. This one where they're talking about a Lien's Inner Circle class. So Lien's Inner Circle is a 3-day class. People fly up here to Coeur d'Alene. They spend 3 days with me and my team. We're going to take them down to the foreclosure auction. We're going to drive them around and show them fix and flips that we're working on in our own backyard. And we're going to teach them how to do this business. and they're going to invest $20,000 to come to this class. All we ask is that they do 4 transactions with Kogo Capital, that's us, that's you and me, over the next 12 months. If they will bring 12 loans to Kogo Capital, either as a broker, as a direct borrower, to fix and flip themselves, if they'll simply bring 4 deals to Kogo Capital over that 12-month period of time, I'm going to give them their $20,000 back. We are the only company on the planet that is doing what we call tuition reimbursement. And to get their tuition back, they need to bring us 4 deals, they need to make payments on those deals, and they need to pay those loans off, which makes them a very well motivated and qualified borrower. Okay, so if you guys would like additional information or you'd like to look at some of our classes that are available, you can go to leearnoldsystem.com and you can read up all about them. And if you'd like to talk with one of our business development consultants, they will be more than happy to chat with you about the different courses and the different offerings. And just know, you guys, every class we offer through our educational division is refundable once you do deals. So if you are interested in being an active fixer and flipper, we will provide you the funding and the education and give you your investment back when you bring us the deal. Sound good? Yeah, it's awesome. Here's a duplex in Schenectady, New York. Loan amount 111, this one appraised at 224. This is a note rate at 11.49%. So if you were to buy this note right now, you would immediately step into an 11.5% return on your cash. And I want you to think about that the next time you look at your 401k balance and you're wondering why it has a little dash mark in front of the number. It's because you're losing principal, okay? With these, you're buying the note, you're getting that 11.49% return, assuming that the borrower continues to make all their payment. Now, here's some borrower information to be aware of. They bought this property in December of 2023 for $5K. They have a job outside of real estate, which is always important and helpful. It reduces the risk of the deal. The borrower lives in New York. The property is located in New York. That's a big telltale sign. It's far riskier to fund notes where the property is in Indiana and the borrower lives in California. Because if they're not there, it's going to be a lot harder for them to manage the property. Now, I grew up on a farm. My grandfather was a cattle rancher, and I'll never forget, he used to always say, he would say, Lee, the best fertilizer for the garden is the footsteps of the farmer. And man, that is so true, especially when you're flipping real estate. Because trying to flip real estate long distances, you lose a lot of connectivity to the deal, you lose a lot of control in that property, and if they can't physically drive there and be on site, meeting with the contractor, meeting with the subs and the suppliers, that deal is going to be a little bit riskier. So for me personally, I want to fund deals on properties where the property is in the same city that the borrower lives in. We have seen over 20 years of doing this, that if they live where the property is, your chances of default are significantly diminished. Borrower plans to rent the property for $2,000 per unit after the rehab is complete. They're going to do interior painting throughout, replace all the existing windows, replace all the carpet with vinyl flooring, replace all the kitchen countertops, new cabinets, repair the vinyl siding, pressure wash the exterior. And as I said, we've escrowed almost $80,000 of this loan. So we've got 30 grand in it. We've got 80,000 escrowed, which we will now oversee their renovation. We will release draws as they prove they've completed the work. And this is how you ensure that as we're releasing your funds to this borrower, that the property value is increasing based on the work that they're doing. Okay. Here's another one in Little Rock, Arkansas. This is a 3-bedroom, 1-bath. This is a loan under 100 grand. So for those of you who are like, oh, these are big numbers, here's a loan under 100 grand. This is an 87.5 loan. It's paying 8. Remember, 8 is great. Market value is 125. They bought this house for $25,000. It's funded at 70% loan to value. They have borrowed money from us and paid us off on 11 other transactions. The best predictor of future performance is past performance. This person has performed 11 times in the past. The probability that they're going to perform this time, significantly high. Okay? So I would purchase this loan with a great feeling of comfort that my odds of getting repaid are like 99.9%. They've done it before, they're going to do it again. Here's one in Center Point, Alabama. Guys, we fund nationwide. So again, when you go to our website, you can sort our loan portfolio by region or state. If you only want to buy notes in Florida, go to my website and type in Florida, and it will just show you notes that we have for sale in Florida. You decide where you want to invest. This is a 3,000 square foot property. We lent 174 grand on this. They bought the property for 125. Fixed up, it's worth 275. They put 34 grand out of their own pocket down. This matures January of 25. This is paying 11.99%, and we're holding $66,000 in rehab for that. Borrowers have previous experience. Both borrowers work outside of real estate. All rehab funds are held in construction draws through Lake City Servicing. Borrower plans to sell the property for $280, and here's a list of all of the things that they're going to do to it. Okay, so this is just a sampling, you guys, of some of the loans that are available. You might want to look at. You can find more of these notes at Secured Investment Corp. And if you would like to have a conversation with one of our investor relations team members, you can either scan that QR code right now on your phone. It'll take you to an application where you can schedule an appointment. I would encourage you to do that now. And you can also go to securedinvestcorp.com/note-investor, where you can learn more about this process, learn more about the note business, and you can schedule a call with our investor relations team member. Now, I would encourage you guys to schedule the call with our investor relations team member, whether you are ready to invest or not, whether you have money to invest or not, okay? Talk to them. Tell them your plans, tell them what it is you're looking to accomplish, tell them what income you have coming in, tell them where you have money. We may have an opportunity or an idea for you to get started in this business when you didn't even realize that was an option. I mean, we are incredibly creative when it comes to finding ways you guys can participate in these loans. So if you are intrigued, if you're interested, if you'd like to learn more, simply scan that QR code or go to that web link there, and you can get an appointment booked. All right, I am right on the nose. Boom, look at that. Right on time, that never happens. It's like a miracle. It's a miracle on 7th Street. That's where our office is located. But I do want to go to Q&A. I promised you guys some Q&A here at the end. So Charlie, Peter, whoever's got them, go ahead and feed them, and I'll give you the best answer that I can.
Mike's on, Charlie.
All right. I don't see my mic on
Should go green.
here. Here we go.
Can you hear me?
Can you guys hear Charlie? Can you hear another voice? Say it again. Say hello.
Hello, hello.
They're not here.
We got
No, they can't.
Can you say the cheese is old and moldy?
The cheese is old and moldy.
Can you hear him now? Okay, good.
Okay. All right. So one of the questions
That
was
quote is from Encino Man, by the way, a very old vintage film. The cheese is old and moldy. If anybody's curious why the cheese is old and moldy, it's Encino Man with Pauly Shore, which is taking you back to the early 90s. So there you go, a little blast from the past. Take it away, Charlie.
So you mentioned both mortgage note and trust deed. What's the difference?
Mortgage note is the document that is securing the asset to the property. The deed of trust is the transfer document that gives you the note information. Okay, so you have the note and the deed of trust. So we're going to record the deed of trust. We're going to hold back the mortgage note. Okay, so all that needs to be recorded is the deed of trust. That's all we have to record on title. The mortgage is often not recorded. So we're going to give you both. The reason we broke that down on both sides is so that you guys understand all you need to record is a deed of trust, but you also need to get the mortgage. That's the document that essentially outlines the terms of the loan and the rules of engagement in the event of default. So you need to get both. So if anybody ever tells you, oh, no, you don't need that. No, you do. You need the note and you need the mortgage, okay?
Right. You also mentioned not investing in a note that has a 70% LTV. Could you explain a little bit why not?
Not investing in a note that has a 70% LTV, yes. Why not invest in a note for more than 70% LTV? Well, let me show you this. Okay, let's assume that this house has a fair market value of $70,000. I'm sorry, a fair market value of $100,000. Okay? 70% of $100,000 is obviously $70,000. Okay? Now, when a property goes to foreclosure sale, when a property goes to foreclosure sale, it will typically sell for 65 to 70% of the as-is value. 60 to 70% of the as-is value is what it's going to sell for at auction. So for you to get this house to go to foreclosure sale is going to take you anywhere from 3 to 12 months to foreclose.
And why 3 to 12 months?
Why 3 to 12 months to foreclose? Because this is the legal timeline that it takes to foreclose in any state. Now, this, what I'm quoting you here, is for non-owner occupied property. If the note that you're buying has a owner occupant living in it, you can plan on 12 to 36 months to foreclose. It takes longer to foreclose an owner occupied loan than it does a non-owner occupied loan, okay? Which is why all of the loans that we originate are non-owner occupied. Now, this 3 to 6 months, typically, while we are foreclosing, the condition of this property is dropping. Especially if this was a rehab loan, so they were working to get it fixed up and cleaned up. Let's say they didn't get all the work done. Well, it never actually achieved its fair market value because they didn't finish the work. Furthermore, a vacant house will diminish in value because nobody's keeping it up. The grass is going to grow tall. Vandals and vagrants are going to bust in there and break windows and break things. And the longer that house sits vacant, the more damage is occurred and the property becomes worth less and less money. To get it to the foreclosure process, you can plan on spending anywhere from $4,500 to roughly $12,000. And these are going to be your attorney's costs. Okay, so $4,500 to $12,000. So now, let's say that 6 months later, this thing goes to foreclosure sale. And the as-is value, so we will order a BPO on this, the as-is value comes in at $70,000. As is. Now I told you guys that a foreclosure auction, a third-party investor, and I am one of them, so my team and I have been buying houses at foreclosure auction for over 20 years. And my team and I are at every foreclosure auction in my market every single week. So we know exactly how long it's going to take and what properties are going to sell and how high people are going to bid. So who's got a calculator? Guys, get out your calculator. Here's what I need to know. What is 70% of 70,000? 70% of 70,000. You should get 59 grand. Did everybody get that? No, you should have gotten 49 grand. Everybody get that? You got 49,000? Okay. So, 49,000. That's what it's going to sell for at auction, and then you're going to have $10,000 in foreclosure fees. Which means you're going to get $39,000 back from your $70,000 investment. That is a loss of principal. We never want to lose principal. Okay? I think Warren Buffett's #1 rule for investing: don't lose principal. Right? You know, you can lose upside. So I put in 100 grand, it made 80, and I'm down 60. Well, I haven't lost any principal. Let me put it in a different term. For all of you who like to go to Vegas and other establishments where you can gamble, I'm not a gambler, but the times that I have, played a hand of blackjack, the first thing I'm going to do, if I put $100 on the table and I win, I'm going to take the $100 worth of chips, I'm going to put it back in my pocket, and I'm going to play with the winnings. And when I'm out, and I walk away. So I didn't lose any principal, okay? That's what we want to accomplish. So the lower your LTV is to the value, the lower your LTV is, the less probability that you're going to lose principal. That's what we want to avoid, okay? So 70% loan to value is the maximum. I don't want you funding deals beyond that. Because if you would have lent this borrower 100 grand, the outcome doesn't change. But now, instead of losing $21,000, now you've lost $41,000. So the loan to value will really minimize your risk. And that's what we want. And hopefully you get all of your principal back. But again, guys, we have a 7% default rate, a 3% REO rate. So while this looks really scary, there's a 3% chance that the note you buy is going to go through this situation. Now, to be clear, those are my statistics, okay? And we've been servicing loans for 15 years. We've been originating loans for 20 years. So we know that portfolio-wide, that's what it's going to be. 7% default rate, 3% REO rate. If you buy loans from anyone else, those numbers do not apply. So remember what I said earlier in this presentation. You always want to ask the person selling the loan, what has their historical portfolio performance been? I'm going to say it again so you guys write it down. What is your historical portfolio performance been? And if they can't answer that question, run, because they don't know, and that's a problem. Next question.
All right. Tia has an interesting one. What is the difference between tax delinquency, tax overage / surplus fund, and how does it compare to mortgage notes?
What is the difference between tax delinquency and
tax overage / surplus fund?
Tax overage and surplus funds. Okay. Just so I don't confuse people, I'm going to get a fresh piece of paper here. Okay, so the first one was what? Tax what?
Tax delinquency.
Tax delinquency. Okay, so tax delinquency. So tax delinquency works like this, okay? You own this house, there's an underlying mortgage for $100,000, and you owe $2,500 in taxes. Now, in most markets, taxes are due every year. Sometimes you pay 2 payments, so you've got you've got payments due every 6 months. Other times your taxes are due once every year. Doesn't matter. But let's say that we get to the end of 2024 and you didn't pay your taxes. Okay, this is now delinquent tax. Now, most municipalities will let you go 3 years in arrears before they'll take the property to tax sale. Now, if this goes to tax sale and the opening bid is the $7,500, then you buy the tax deed, and I want to be very clear on something. Are you buying the tax deed or are you buying the tax lien? And there's a very big difference here. If what you're buying is the tax deed, then you get the property. You just bought a $100,000 property for $7,500. But tax deed sales have bids. So there's no guarantee that you're going to be able to buy this. I just bought, just a few weeks ago, I bought a tax deed on a mobile home like 4 miles from my house. Now it's a mobile home on its own lot, nice big shop. The opening bid on that was, I want to say it was like $40,000. Fixed up, this place is worth 300 grand, okay? But the tax deed, because the municipality can only open the bidding for what they're owed. And on this deal, they were owed 40 grand. So we now go into a tax deed bidding environment, and I ended up paying $79,000 for that tax deed, which means I now own the property. But the taxes were $40,000, and these are owed to the county. I paid $79,000, which means we had overage proceeds of $29,000. Overage proceeds belong to the property owner. So this $29,000, if the owner of this property was Larry and Linda Brown, this $29,000 in overage proceeds belongs to them, not the tax assessor. What did you say, Peter?
39.
Did I say 30? Oh, thank you. 39. Okay, so this $39,000 belongs to Larry and Linda Brown. They're the property owner. Overage proceeds go to them. Okay, that's a tax deed sale. Now, you can also purchase tax liens. Now, a tax lien sale works like this. And let's use the state of Texas, because the best place to buy tax liens, in my opinion, is the state of Texas, and here's why. In the state of Texas, a tax lien pays 18% every 6 months. So if you buy this, you get 18%, which means at the end of the year, you get 36% annually. However, in a tax lien sale environment, you don't bid up the amount you're willing to pay for the taxes. You bid down the yield, okay? So if this is going to go, opening bid is $7,500, and I say $7,500 market value. I'm saying I will buy the lien for $7,500, and I'm going to earn 36% return on my money. Then Charlie's going to come in and he's going to go, I will pay $7,500 for the lien, but I will do it for 20% annually. And then somebody else comes in and says, well, I'll do it for 15% annually. And somebody else comes in and says, I'll do it for 10% annually. And somebody else comes in and says, I'll do it for 5% annually. And what they'll do is they'll squeeze out all of the yield. So personally, I do not bid on tax lien sales. That's a personal preference. I know there's a lot of courses out there that are great, and if you are making money at it, keep doing it. Personally, I'm not interested in bidding down yield, because I can originate yield and get guaranteed yield by originating paper or buying existing. But I do buy tax deeds, because in those cases I get the property, and that's ultimately what I really want. Now, that wasn't the actual question. I addressed tax deeds, tax liens. The question was, what are the overages in an auction? Correct, Peter? Okay, so going back to our original example, right? We wrote the loan at $100,000, but in this case, the property is worth substantially more. Okay, so in this case, let's say that the fair market value of the property is 300 grand. Now, if the sale if it goes to auction and 70% is bid, how much does somebody buy this property for? Get out your calculators and you're going to come up with $210,000. Okay? Now, if you own this note and the bidding goes to $210,000, you get the first $100,000. So this first $100,000 goes to lender, including accelerated interest costs, foreclosure fees, any property taxes that you fronted, any insurance payments that you've made, anything you've fronted to maintain the value of the asset, you can get it back from the foreclosure proceeds. So these go to you. However, any overage proceeds, which in this case would be $110,000, these go to the borrower. So if there are overage proceeds at a foreclosure auction, they always go to the borrower, which is why if somebody came to you and said, hey, I've got this loan, it's in foreclosure, you can buy it because the fair market value of this thing is worth 300 grand. So if you buy it for 100,000, you could get $300,000. No, they don't understand what they're talking about, and they're lying to you because the overage proceeds belong to the borrower, not the lender. All you are entitled to as a note buyer is the face value of the note, interest payments, collection fees, accelerated interest costs, attorney's fees. That's it. Any upside equity belongs to the borrower. So please don't get duped on this. I've seen a lot of people who don't know what they're doing, buying notes from people who know what they're doing but don't care about you. And man, it is a recipe for disaster. So please avoid that.
We just got a couple more. They're actually related. One
Okay.
is there a minimum to a note investment that we offer? And then do we offer a fractional note
Okay.
investment?
So guys, our minimum. So we will not originate a loan for less than $30,000. Now, we don't originate a lot of loans for $30,000, but if we do, I can tell you that any loan that hits our website like under 100 grand will be sold in 24 hours. So if you're looking for loans under 100 grand, you need to set up a autoresponder in our website so that we can notify you when these loans come out, because those loans sell very, very, very quickly. All right. So anything under 100 grand is solid gold, and it's going to move. Anything over, usually anything over 250 or 300,000, there's a lot fewer people that can wire a check for 300 grand versus those can wire a check for 75 grand. So the bigger loan amounts don't sell as quickly. However, if you are an accredited investor, again, this means that you have $200,000 per year in income, and you are single, or you have $300,000 per year in income, and you are married, or you have $1 million in assets. Again, this excludes equity in primary, in your primary home. Okay? These are what make you an accredited investor according to the Securities and Exchange Commission. If you are an accredited investor, and right now, again, if you're watching this live, this is a true statement. If you're watching a recording of this, this may not still be true. Go to Secured Investment Corp right now, you guys. All of you, go to securedinvestmentcorp.com and click on Notes. And then I want you to sort your search for loans over $300,000. Okay? Now, in there, you will find a loan, and help me, are you guys there? There's a loan in there, I want to say it's for $549,000 or $449,000. It's in, I want to say it's in Mississippi or it's in Louisiana, and it's paying 13.49%. Find me that note.
You said it was in LA?
It's in Louisiana or Mississippi. It's in one of those markets.
And what was the return?
13.49. Anybody at home finding it? It's in there. I just looked at it yesterday. Okay, well, you guys keep looking. I'm going to put in a placeholder here that it is a, let's just call it a $500,000 loan, okay? If you are an accredited investor, you can buy what's called a partial, and you can buy a $50,000 interest in this note. So essentially, if you invest $50,000 in this note, we assign to you 1/10 ownership of the loan. Again, you have to be accredited to be able to do this. but it is a great, great thing for those who would like to diversify your money over multiple loans, because you can be in $50,000 positions. If you've got 100 grand, you could buy positions in two $50,000 notes. If you've got $200,000, you could buy four $50,000 positions in four different notes. So instead of buying one $200,000 loan, you could buy four $50,000 loans, which is pretty cool. Here's the other nice thing, is that these loans, we will only offer 49% interest in partials. Which means we as a company will retain 51% ownership. So let's see, 51% of 500,000 is what, 200, let's call it 255,000. Okay, so we as a company will stay essentially in the dominant position here. So we will sell 49% interest in these loans. We retain 51% ownership. So we get 51% of the monthly payment, you get 1/10 of the monthly payment, but it's still a 13.49% return to all of us. So we're all benefiting from this 13.49% rate loan. In the event of default, we will front all of the foreclosure fees. Now, we're going to get all of the money that we front at auction, and we will recover all of our fees first before anybody else is paid out. But the nice thing is that you don't have to front any of the foreclosure costs, the legal costs. You don't have to be the one making decisions on, do we sell it, do we modify it, do we do this, do we do that. That's why we retain 51% ownership, so that we can maintain controlling interest and we can make the decisions for the deal. Now, the nice thing for you guys is you can rest assured that as a company who's been doing this for 20 plus years, the decisions that we make are going to be made to ensure we don't lose principal. All right? So if you are highly risk adverse, meaning you don't like risk at all, in my opinion, these are one of the best investment options that you have, because you've only got 1/10 interest in a note that we have the majority lien or the majority interest in. We're going to manage everything about that note. And if worst case scenario does happen, we're going to take it from there. Okay? And if worst case never happens, we're going to service the loan. We're going to send you your 1/10%, 1/10 ownership interest payment every month. And when it pays off, you'll get your $50,000 returned and you can redeploy it, re-up it. Now, I want to close with this. How many more questions do we have?
That's all.
Okay, well, if there's more, I don't have time. So I want to close with this because I told you at the beginning I would show you this. All right. Now, here's a great thing. And I want to eliminate this so I have more room to write. If you know accredited investors and you are not an accredited investor, or maybe you are an accredited investor but you're fully deployed, so you don't have any liquidity right now, but you have a friend or a family member that you know is sitting on $50,000 and they're looking for somewhere to put it. You can bring them to Secured Investment Corp. Again, you can go to the link, you can schedule an appointment with one of our investment one of our investment consultants, and they can help you get this money deployed. But you can tell your friend or your family member that you know a place where you can put money and you can get 10% interest on your loan secured by real property. So they bring in their $50,000, and this is where we're now going to subservice. Okay? So they bring in 50 grand. We're going to service the loan. We're going to send 10% to them, and then if you have them buy into this note, for example, we're going to send you 3.49% interest for the next 24 months. Now, let me show you guys how to do this math, okay? Take $50,000. Remember, these are interest-only loans, so you don't need to do any amortization calculations on these. And do this $50,000 times 3.49%. And tell me what you get. Does anybody in here have a calculator?
1740.
I left my phone in my office, so I am calculatorless. All right, so here, thank you. So all I'm going to do is I'm going to take $50,000 times 3.49%. And what I get is $1,745. Now, you're going to get a check every month for, so divide this by 12 months. You're going to get a check every month that this borrower pays for $145.41 per month. So again, on their $50,000, so $50,000 times 10%, your friend or your referral is going to get $5,000, because remember, they're getting 10% per year. Divide that by 12, and they're going to get a check every month for $416.66. So the borrower now, if you add these two things together, $416.66 plus $416.66 plus the $145.41, the borrower is essentially paying $562.07 to borrow your friend's 50 grand, but your friend is getting a check for $416 every month. You're getting a check for $145.41 every month, and all you did was refer them in. Okay? So again, this is called sub-servicing. Now, we had a phone call with some of our investors just last week, and they told us they were doing this, but said it like in a way that they didn't want us to know they were doing it. Like, we're doing something that we're not supposed to be doing, and we don't want you to know, but we're telling you because we want to be transparent and we want full disclosure. Well, I said, guys, I don't care. And I encourage subservicing. Everyone should be in the subservicing space because it allows you to get little strips of income off of somebody else's money. I think it's genius, and you all should do it. So, if you would like to talk with somebody about any of these strategies, again, hover over that QR code with your phone and schedule an appointment to talk with one of our investment consultants. And you can go through the different loans that are available on our website. You can tell them if you don't see any loans on our website that you like or that meet your investment criteria, just tell them what your investment criteria is. Guys, we're originating loans all day, every day. We fund millions of dollars of loans every single week in this organization. If we know you're looking for a particular type of loan, you could even have some influence on how we write the loan, how we fund the loan. So if you got cash and are looking to deploy it, let us know what you want to accomplish, and we'll make sure we help you accomplish it. All right, guys, I apologize. We are out of time. Hopefully this was hugely informative for you. And if you would all do me a favor, before you log out of here, I want you to write into the chat, what was your aha moment from tonight's training? What was your favorite part? What do you love about Lee Arnold and Kogo Capital and Secured Investment Corp? Because I want to take your comments and I want to put them on my website and use you to say great things about us. Cool? So I didn't charge you anything for being here, not selling anything other than the opportunity to get money deployed and earn interest. So what I'm asking for in return is like a little testimonial quote, a little, hey, wow, this company's awesome. They're the smartest people on the planet Earth. If I had $1 million, I'd give it all to them. Whatever you want to say, I'm not influencing this in any way. But your comments and your feedback are greatly appreciated. So thank you all for joining us. Have a great rest of your evening. Have a great rest of your year. Happy investing to all of you. And God bless. We'll see y'all later. Bye-bye, everybody.